Welcome to the debate. Welcome to Breaking News to Trading Moves. Today, we are exploring a tactic that sits right at the intersection of mathematical probability and human psychology in financial markets.
Right, yeah. We're talking about the incredibly common practice of moving trading stops to break even. It is the exact scenario every market participant faces daily.
Absolutely. You execute a position, the price begins to move in your favor, and immediately you face a choice.
So the central question we're tackling is this. Is adjusting a protective stop loss up to your exact entry price a disciplined tactic that protects capital? Or, is it an emotional crutch that quietly degrades a profitable strategy over time?
And it is a compelling tension, really, because almost every introductory trading guide teaches you to protect your profits as soon as possible.
Oh, they definitely do. It is everywhere.
Right, so for my part, I will be arguing that structured break-even stops, when applied logically rather than reactively, are absolutely essential mechanisms for capital protection and long-term risk management.
And I take the opposing view here. I argue that moving stops to the entry price provides a mere illusion of safety. It is very often just fear disguised as discipline.
A harsh assessment, but okay.
Well, that premature adjustment suffocates otherwise valid trade setups, and ultimately it destroys your mathematical edge.
Let me outline my perspective on why this practice is vital. Over a long career, a trader's primary job isn't actually making money. It is preserving capital so that their edge can play out over thousands of executions.
Okay, capital preservation, sure.
Yes, because when you enter a trade, you accept a specific amount of predetermined risk. But once that trade moves in your favor, the risk profile of that specific position changes.
But does it really?
It does. Protecting your original capital at that point prevents severe financial drawdowns. By removing risk from the table, you limit your exposure to unpredictable, uncontrollable events.
Unpredictable events like what?
Well, think about a sudden central bank announcement, an unexpected geopolitical headline, or just a random spike in market volatility. Locking in that entry price ensures that a verified, winning position doesn't turn around and damage your portfolio.
I see.
It is a necessary protective practice for long-term survival. You are simply securing the ground you just gained.
I understand the appeal of that logic. I really do. It sounds responsible, prudent even, but my perspective is driven entirely by the mathematical reality of strategy expectancy.
Go on.
Moving a stop to break even is, at its core, an emotional trap. The most crucial concept a participant must internalize is that your personal entry price has absolutely zero technical importance to the market.
Wait, zero importance?
Zero. The global order flow does not care where your specific coordinate is. By dragging your protective line up to an arbitrary entry price, you are placing your defensive stop directly inside standard market breathing.
Standard breathing, sure, but
And by doing that, you are virtually guaranteeing that your trades will be closed out during standard algorithmic liquidity sweeps. This inevitably lowers your realized win rate. It completely damages the mathematical reward to risk profile that made your strategy viable in the first place. You are protecting your feelings, not your account.
I hear what you are saying about the market not caring about my entry price, but we cannot ignore the human element here.
The human element.
Right. We aren't robots executing code, We are executing strategies day in and day out under immense cognitive pressure. Let me offer an analogy to explain the protective mindset.
All right, let's hear it.
When a highly skilled mountain climber scales a challenging peak, they rarely attempt to make it from the absolute bottom to the summit in one continuous, unprotected push. They climb up, they establish a base camp, they pitch their tents,
Okay.
and they secure their progress with ropes and anchors. If a severe storm hits, they only fall back to that newly established camp. They don't tumble all the way down to the valley floor, losing days of grueling effort.
I see the visual you are painting.
Yeah, and protecting an open profit works exactly the same way. It prevents the devastating psychological damage of watching a position go up 2 units of reward, only to reverse and hit your full initial stop loss.
Right, but
Because that psychological spiral often leads to revenge trading and poor decision-making later in the session.
the mountain climber analogy is vivid, I will give you that. But it breaks down when we apply it to market mechanics. Let me explain why.
All right?
A mountain is a static object. The mountain isn't actively looking at your base camp and trying to pull you down. The market, however, is highly dynamic. It actively hunts for liquidity.
Hunts for liquidity? Yes.
So let's talk about why it hurts so much to watch a green trade turn red. It comes down to a well-documented cognitive bias called loss aversion.
Right. The idea that losses hurt more than gains feel good.
Exactly. Human psychology is wired to feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. When you enter a trade and the price moves into profit, your mind immediately processes those green numbers on the screen.
Yeah, it feels real.
Too real. It treats that unrealized gain as if it already belongs in your bank account.
Which makes sense because it is capital that you have legitimately captured from the market's movement, even if it remains open.
But you haven't captured it until you close the position. That is the critical distinction. So when a completely standard structural retest occurs, the market just breathing, it feels like money is being physically taken out of your wallet.
I completely agree with that feeling.
Right. So moving the stop to the entry provides immediate emotional relief from that anxiety, but it is toxic comfort. You mentioned the market not caring about your entry. Let's go into why price so often returns to that exact level.
Okay, let's hear it.
Large institutional participants need massive liquidity to fuel the next leg of a move.
Let's pause and explain the mechanics of that for a moment. How exactly does the institutional need for liquidity interact with a retail trader's break-even stop?
Institution wants to buy 10,000 contracts. If they just hit the market buy button, they will consume all the available sell orders on the order book instantly. The price will skyrocket, and they will get terrible average pricing due to immense slippage.
Right, they need sellers.
They need a concentrated pool of limit sell orders to execute their massive buy order against. And where do those concentrated sell orders sit? Right at the break-even stops of retail traders who moved their protection up too early.
So they are targeted.
Yes, the algorithms are specifically programmed to target those clusters. They engineer a temporary price drop to your entry, trigger your stop, which converts into a sell order that they gladly absorb, and then the market reverses and marches toward the original target.
Wow, okay.
By moving your stop to your entry, you are turning your own position into the exact liquidity fuel required for the move you originally predicted.
Toxic comfort, huh? That feels like an overly harsh assessment for a practice that literally guarantees no initial capital is lost. Let's look at the practical net outcome for the account. Traders routinely log break-even trades as harmless.
But they aren't harmless.
There is very sound logic there, though. A $0 outcome is always mathematically and psychologically preferable to taking a full unit loss.
I disagree entirely.
Just hear me out. If I take a trade, move my stop, and get taken out at my exact entry, my account balance is preserved. In an environment where capital is your only inventory, walking away with a scratch feels like a highly disciplined decision. It preserves the mental capital to take the next trade without hesitation.
But this is exactly where the math turns against the break-even habit. A break-even trade is almost never truly a $0 outcome. We have to look at the execution mechanics.
What do you mean?
During those volatile liquidity sweeps we just talked about, what happens to the bid-ask spread?
Well, the spread widens because liquidity momentarily dries up. The market makers step back during rapid price fluctuations.
Precisely. The distance between what buyers are willing to pay and sellers are willing to accept expands dramatically. If your protective stop is resting exactly at your entry coordinate, that widened spread will often trigger your market order slightly below your entry line.
Oh, I see. Slippage.
Yes, you don't get filled at your exact break-even price. Once you account for the spread expansion, the broker commissions, and standard market slippage during a fast move, your supposedly harmless exit turns into a small mathematical loss.
A small loss, yes, but
You might be losing a fraction of a percent, but you do that 50 times over a quarter, and you have created a measurable drawdown purely out of execution costs. It is death by 1,000 paper cuts.
I see your point regarding the frictional costs of trading. But let's maintain a sense of proportion here. Even factoring in a tiny commission fee or a fraction of a point in slippage, that micro loss is vastly preferable to taking a full risk loss.
I still don't think it is.
Come on, it keeps you alive to play another day.
You are entirely ignoring the opportunity cost, which is far more destructive over the long term. Let's use a retail store analogy.
Okay.
Imagine running a highly successful retail store and putting your best-selling product on the shelf. For the first hour, it sells rapidly. Then foot traffic slows down for 5 minutes. Because you get nervous about the lull, you immediately pull the product off the shelf to protect your inventory.
So you save the inventory.
You save the inventory, but you miss the entire weekend rush. In the market, you did the heavy lifting. You analyzed the conditions. You waited patiently for the specific setup. You executed the entry flawlessly, and you accepted the initial risk.
Right, you did the work.
And yet you capture absolutely nothing from a move that later works out exactly as you forecasted. You paid the risk admission ticket but walked out before the show started.
That is assuming the trade eventually works. What about the times it doesn't? What about the times that minor retracement turns into a complete trend reversal?
That happens, sure.
A sudden macroeconomic report hits the wire, and the market cascades in the opposite direction. The break-even stop saves you from a full loss in those very real scenarios.
That is precisely why we rely on expectancy over a large sample size, rather than trying to micromanage individual trade outcomes. Let's walk through the actual math.
All right, let's hear the math.
Imagine a strategy with a 40% win rate, aiming for a 2-to-1 reward to risk ratio. Let's use round numbers. For every 10 trades, you lose 6 and you win 4.
Okay, standard setup?
If you risk $100 per trade, your 6 losses cost you $600. Your 4 wins, earning $200 each, make you $800. You net a $200 profit over the series. That is a robust, functioning edge.
Right, you are profitable.
Now, what happens if you intervene and move stops to break even on just 2 of those winning trades because you got nervous during a structural retest?
So you were saying those 2 wins become scratches, $0 outcomes.
Right, let's recalculate the expectancy. You still have the 6 normal losses, which is minus $600, but now you have 2 break-even trades yielding 0 and only 2 actual wins remaining.
Oh, I see where this is going.
Those 2 wins make you $400. You just turned a perfectly profitable proven system into a net negative system, losing $200 overall. The math is brutal and unforgiving. By trying to avoid small discomfort, you completely destroyed the positive expectancy of the model.
Okay, I see the math there. But you are assuming the break-even stop only takes out the winners. It also takes out trades that would have been full losses. Doesn't that balance out the equation?
Well, the data overwhelmingly shows that premature stops disproportionately kill winners, because winning trades require room to breathe. And there is a secondary effect that is even more damaging.
What is that?
Repeated break-even exits actively encourage overtrading.
Let me push back there. How does protecting your capital lead to overtrading? If you preserve your capital, you can simply wait for the next setup tomorrow with a clear head.
In theory, yes. In reality, let's walk through the psychological loop in slow motion. The trader correctly identifies the macroeconomic trend and the market direction. They get shaken out at break-even during a minor, entirely predictable pullback.
Okay.
They sit there at their screen and watch the price begin to surge in their original direction again. What happens next in the human brain? Immense frustration takes over, followed rapidly by the fear of missing out.
Yeah, the FOMO hits hard.
Exactly. They jump back into the market at a much worse price, taking on brand new risk and paying the spread a second time. They are right about the market direction, but because they couldn't endure the natural fluctuation of open profit, they end up churning their own account.
So they multiply their risk.
Yes, they turn one well-planned, elegant trade into 3 messy, emotional executions, multiplying their risk exposure along the way.
Okay, I will concede that a purely automatic, fear-based break-even rule, like moving the stop the very second a trade shows 10 points of profit, is a flawed approach. It reacts to the profit and loss column rather than the actual price chart.
Glad we agree on that.
But I maintain that a robust, tested plan absolutely must include break-even adjustments. There are instances where it is entirely logical and necessary based on market structure.
I am certainly open to hearing about structured adjustments. What specific instances do you consider structurally valid for moving a stop to the entry?
When the market structure itself dictates it. For example, when major daily resistance has been clearly broken and the price has closed well beyond that zone, or when part of the position has already been closed for profit at a predefined reward to risk level.
Scaling out?
Exactly. Say you take half your position off the table at a 1-to-1 ratio. At that point, moving the remainder to break even guarantees a profitable trade overall, allowing you to hold the rest stress-free. Furthermore, let's look at the empirical data itself.
The data?
Yes. If we connect the dots in a trader's journal and the data clearly shows that moving a stop after a specific gain mathematically limits drawdowns over 100 trades without degrading the win rate, doesn't that evidence validate the break-even approach for certain setups?
I agree entirely that market structure matters, and I agree that adjusting risk based on a tested plan is the right methodology. If your personal journal proves it works for your specific strategy, you follow your data.
Right.
But I still maintain that the specific alternatives to the break-even stop are far superior. If the structure has developed in your favor, why anchor your stop back to your exact entry price?
Because the entry price represents the zero loss threshold for the account. It provides a clean psychological slate. It eliminates the financial risk.
But again, the market doesn't operate on your psychological slate. If you want to trail your risk, you should trail it behind confirmed swing points. Let's break down how that works mechanics-wise.
Walk me through it.
If price clears major resistance, your stop should move beneath the new structural low that formed the breakout. That new structural low might be below your entry, or it might be well above your entry. It should never default to the entry simply because of the emotional comfort of a zero.
So you are advocating for dynamic trailing stops based strictly on structural mechanics rather than static, break-even stops?
Exactly. Trail behind confirmed swings. Or use volatility-based stops.
Let's explain that for a moment for clarity. Using a metric like the average true range, or ATR, how does that practically keep you out of the noise while still protecting capital?
Well, the average true range measures the normal historical volatility of an asset over a given period, usually 14 days. It tells you exactly how far the price typically moves from high to low in a single session.
Okay, so it gives you a range.
Yes. If you use a multiple of the ATR, say 2 times the ATR to trail your stop, you give the market exactly the amount of breathing room its current volatility requires. If volatility expands because of an earnings report or a news event, your ATR value increases and your stop stays wider to accommodate the violent chop.
That makes sense.
And if volatility contracts, your ATR value drops and your stop tightens naturally. It adapts to the environment. But the absolute rule must be this: a defensive stop should only sit where the core technical premise of the trade idea is completely invalidated.
If the idea is wrong, you get out.
Right. If that invalidation level hasn't changed, moving the stop just because the price is slightly profitable makes zero strategic sense. The decision has to be driven by data, structure, and volatility, never by the discomfort of watching open profit fluctuate.
It is a delicate balance. On one hand, we have the mathematical purity of letting a trade play out to its logical conclusion, accepting the full risk you agreed to up front.
Yep.
On the other hand, we have the very real necessity of preserving capital and psychological stability in an unpredictable environment.
It is a delicate balance, but the data rarely lies. The core lesson is that proper risk management isn't about avoiding every single loss. It is about accepting planned losses while giving profitable trades enough space to deliver their expected return.
Which is incredibly hard to do in real time.
It is. Moving every stop to break even creates this seductive illusion of safety, but it slowly removes your edge. Sometimes true discipline means protecting the position aggressively because the underlying structure genuinely changed.
Right.
But at other times, true discipline means sitting on your hands, allowing a liquidity sweep to happen, and following the original plan.
This tension between managing your emotional comfort and maintaining a strict mathematical edge in the markets is something every single participant has to navigate.
Absolutely everyone.
For my part, I firmly believe that protecting a position aligns perfectly with strict discipline, provided it relies on clear rules, major structural levels, and predefined reward-to-risk metrics, rather than simple fear. When the market grants you the opportunity to secure your capital without violating structure,
you take it.
And I reiterate that true risk management requires an acceptance of the initial premise. You have to give the trade enough room to work.
Yeah.
By acknowledging that minor retracements and sweeps are a necessary component of order flow, you allow those profitable setups to actually reach their targets. Otherwise, you suffer the death of 1,000 cuts, paying opportunity costs and spreads while watching your correct ideas play out without you.
Well, the debate over where logical capital protection ends and strategy degradation begins is clearly ongoing. There's certainly more to explore in the material when it comes to trade management.
There is always more to explore.
We encourage all of you listening to connect the dots in your own trading journals. Look closely at your data. Track exactly how often price returns to your entry before eventually hitting your target.
Yes, analyze what happens when the original stop remains untouched versus when it is moved. The answer to whether it works for your specific strategy lives right there in your own data.
So before you rush to establish that next base camp on the side of the mountain, make sure you understand the mechanics of the terrain and ensure you aren't just letting a fear of the wind dictate your climb.